Now, for another take on the vulnerability of our banks, and we have Bill Shorten at the moment asking for a Royal Commission, and we're going to ponder whether it's actually necessary. And what would be the effects on the share prices of banks if a Royal Commission came about? We have our banking specialist from the Switzer Super Report, Paul Rickard. Hi, Paul.
Good evening, Peter.
How are you?
Great. It's hard being a bank lover in this market, isn't it?
That's right. Yeah, it's funny, you know, like we might hate the banks, but we love them when we want a loan to buy the house of our dreams.
Not sure anyone loves a bank, but anyhow,
you know, when you
we need them. I think they're a necessary.
They're an accessory to the love experience of buying a home, and but of course there's always a few experiences. But let's just go through some critical issues. Let's talk about the market in segments. You know, like top 20. You know, the mid caps, the small segments. What is the overall year-to-date performance?
Yeah, I think what I'm going to show you, Peter, really explains what's going on a little bit. So we're going to have a graph here that will come up on screen hopefully in a minute that will show you the different components of the market and what's actually going on. So the ASX 200, the big macro market, as you look at, is down 5.6% year-to-date. And that's, of course, that includes some dividends, but it's down 5.6%. The top 20 stocks, now this is, of course, the four major banks. It's the Macquarie, it's CSL.
It's the one a lot of us have in our
Wesfarmers,
portfolios.
Woolworths and Telstra.
We'll see that chart in a minute, Paul. I'm sure they'll get it up, you know, sometime in this next 10 minutes. Yeah?
It's down 10%.
Right.
So the top 20 is underperforming the market, and that's one of the reasons why the market
10%. That's huge.
Is really
there
struggling.
it is there.
The mid-cap 50, which is stocks number sort of 51 to 100, they're actually in the green, so up by 1.2%. What we call the small ordinaries, which are stocks number 101 to 300 by market capitalisation, they're about flat for the year to date. So all the damage is being done at the top end of the market.
Yeah.
And it really is showing you, I mean, as sort of institutions look around, they don't like banks, they don't like Wesfarmers or Woolworths, they don't like the resource and the oil companies.
Don't like Telstra.
Don't really like Telstra. So they're searching for yield and for earnings growth in some of the industrial and consumer discretionary stocks.
Yeah.
They tend to be sort of around the middle part of the market. A little bit of value seeking in the all ordinaries, but it does sort of tell you why it's so hard for the market to go up.
Okay.
And until you get the sort of the top 20 represent about 50% of the market by market cap. So until you get a bit of love,
hurts the index.
Yeah, until you get a bit of love back for the top 20 stocks, it's really hard for our market to make headway.
But Paul, the top 20 pretty well copped it after March last year, didn't it?
Yeah, look, I mean, it is reversing something has happened. If you go back to 2011, 12, 13, 14, the top 20 outperformed.
Yeah.
And since as you say, Peter, since about March last year, the top 20 have been underperforming. That underperformance has been greater in the last sort of 6 to 9 months, particularly with the commodities market and your BHPs and Rios and Woodsides doing it so tough. But in the last sort of 4 to 5 months, we've seen the banks sort of join that, and of course Woolworths and Wesfarmers remain outside that as well. So, and even Macquarie has had a pretty shocking year on a year-to-date basis.
Yeah. So it seems to me, if you're a contrarian, you're probably saying these top 20 stocks, you know, they're fairly an important representation of the Australian economy. They could easily come back.
Yeah, and I think that's going to happen, but I think at the moment the market is still pretty negative.
Yeah, they are negative.
And although I'd like to agree with the previous, with Michael Knox's assessment, you know, 5,300 or even higher, I think it's going to take some work to get there. We need a bit more love coming into this top part of the market to get it to higher.
Well, I guess if BHP and Rio and the banks can get a little bit of love, that's going to put some momentum into that rise.
Yeah, I think you made a comment that the Doha meeting, oil prices stability is really important. Stability in hard commodity prices is important. And maybe as we get into banks earnings season, that's coming up in the first week of May. So we have ANZ on the 3rd of May, National Australia Bank on the 5th of May and Westpac on the 2nd of May, one after the other effectively. Look, the market will really watch what they've got to say, and
particularly debt provisions will be important.
and if you know, they got really excited when ANZ increased provisions by 100 million, which is just sort of a drop in the ocean type stuff. And some of these headlines we're seeing, the one you talked about from Bloomberg, there are so many scaremongers out there. If the banks actually turn around and say, look, things aren't actually as bad as some of the people are saying, we might see a bit more love.
The newspaper people, well, the website people are exaggerating our demise.
Just a little bit.
I wouldn't mind a headline like that. Okay, so that's it, Paul. Why don't we go and look at the calls for a banking royal commission? Is there any good reason for one?
Look, I think, again,
Remember, you are biased.
I'm a little bit biased as an ex-banker. So,
ex-banker and starting Comsec and all that sort of stuff, but still.
Have a few mates in the banking sector, so just to get that out.
Who you want to keep
as a mate.
Okay.
Look, I read what Bill Hayden's got to... Sorry, not Bill Hayden.
Really short. You've gone back in time there.
I'm getting... It's called dementia, I think, early onset.
Bill Shorten, yes.
Bill Shorten had to say, and he set out sort of an outline of it in terms of reference, and it's largely about behaviour and his... I think that's really where he's coming from. I think a couple of things have got to be said. We've had a lot of inquiries, a lot of Senate inquiries into the banking sector. We had the financial systems inquiry last year from David Murray. That looked at all the issues to do with capital and regulation, and he basically came away with the conclusion that the banks aren't too bad, a little bit of work, they need a bit more capital. I don't think there's much really substance behind a Royal Commission, because the question you've got to ask, what's going to happen as a result of it? It's going to take 2 to 3 years, cost $50 million at least. We've got to look at behavioural issues that ASIC and others have already been probing. We're going to get a lot of some aggrieved borrowers, some aggrieved other parties come to it. When we get some recommendations, what happens as a result of it? And we've seen that just because you have a Royal Commission doesn't mean that recommendations get implemented.
Yeah, that's true.
I mean, the coal inquiry into the building environment and the most recent one, governments don't always choose to implement these things. So, look, I think from a shareholder's perspective, and even from a consumer's point of view, I'd say what's the point of it apart from really sounding nice politically?
Do you think that the share prices of banks will be affected over the period of the Royal Commission?
Look, I think if we get down that path, yeah, I mean, there's going to be, obviously, there's banks are going to be spending a lot of money defending and answering questions. But look, let's get through the election. Let's even see whether the Labor Party's committed. It should, by some chance, get into government.
It might be actually cheaper. It might be actually cheaper if, say, $1 million is put aside and 3 really good journalists were allowed to play day-to-day cop on the behaviour of banks. Because Adele Ferguson was very important to a lot of the exposés here. So we've got 3 really good journalists continually watching what banks do. That could be a lot cheaper than a silly Royal Commission.
There could be a new opportunity for you, Peter.
Oh, no. I'm too busy.
Right.
I'm too busy
about funding ASIC, and does ASIC have the powers? I think all the data says ASIC does have the powers. Yeah. If you want to come back to banks, I actually did prepare another chart if we've got time, Peter.
Yeah,
just look at the current short positions. We sort of focus on this. Comes back to how much banks are or aren't in love. Now, this is sort of holding about the same. So we've got sort of 2 columns here. The first column is the percentage of their shares that are currently short sold. These are figures from ASIC today. Yeah. So ANZ has currently got almost 3% of its shares short sold, about 81 million shares in total. That's worth almost a couple of $1 billion. So there's some serious money here betting on the banks. Now, those numbers aren't going up, so it's not getting any worse. Banks sort of hit today new lows that they saw back in February. I think we're back into sort of buy zone. I mean, this is the sort of the prices we're getting today are the prices that they issued equity at last year. $70.50 was the price Commonwealth Bank did a rights issue last year. ANZ's NAB is down about the same sort of level. I think we're getting back into value, but I'm not sure we're ready for a big change in sentiment just yet. So maybe some work to be done first. Yeah,
and it seems to me we need a good run of good economic data here and abroad. We need decisions like Doha, where the oil price at least freezes over. It freezes over, it doesn't go down anymore. We need to see good earnings coming out of the US, or good earnings outlooks, and put all those together, we might have a reason to go up. At the moment, I think we're in consolidation phase. Yeah, a little bit of revenue growth. So I think the bank reporting season, that first week of May, is really critical. Yeah. Look, we won't... And debt provision. Yeah, so people will be watching, is there any revenue growth? Okay, they're probably doing some work on expenses. What's happening to the credit provisions? Yeah. And probably, I would guess that we'll probably see dividends maintained. So, look, that won't put the dividend naysayers out of the equation. But if ANZ is confident enough to maintain its dividend, there's certainly some analysts there looking for a slight dividend cut. That will probably be seen as a long-term positive. But current yields for these banks are really high. Well, we've got ANZ yielding 7.8%. Before franking. Before franking. NAB almost the same today. Commonwealth Bank at 6% and Westpac at 6.7%. So it's a very attractive yields. But sentiment is stacked against them, and we need a bit of a catalyst to get this to get a rally going. Without a doubt. Thanks, Paul. That's Paul Rickard. If you want to see Paul's great work, have a look at the Switzer Super Report. After the break, Chief Economist at Capital Economics, Paul Dales, will give us an objective assessment of Australia's housing debt issue.